Hey, everybody. Welcome to the weekly financial thing, peer-to-peer lending and investing live stream. It's me, as always, same person that's here every week, bringing you the chit-chat about peer-to-peer lending and investing. Welcome to everybody in the stream. Hope you are having a great week. Crazy to think we're already at the end of August almost, and the year just seems to be motoring along so quickly now. And even though we're having all these issues, COVID, what's going on in the world economies, and time just keeps on going. So, yeah. What are we going to talk about today? Well, we got a few things. Again, a relatively quiet peer-to-peer lending week. A few bits of news. Assetz Capital, Lendinvest, Ratesetter, Growth Street, Lendy have a new report that came out from the administrators this week. We got Zopa news, Crowdlords, Loanpad update, some other economic news stories that I will chit-chat, and anything that you want to talk about, pop your questions in the comment section, and we'll have a chat about those also. It's great to see everybody. Hi, Keith. Nice to see you in Lincoln. I've been to Lincoln many times, Keith, being so close to Grimsby. And I remember the cathedral. That's the one thing I remember about Lincoln, was the cathedral. But I think most cities in the UK have cathedrals, so maybe it wasn't. Hi, Peter in Leatherhead. Nice to see you. Florida, yes, it's actually, for anybody that's ever been to Florida, it's very stormy every afternoon. So we get the sun in the morning, and then sort of mid to late afternoon, the thunderstorms start to come in. Generally very nice. Hi, Tony in Somerset. Colin in the Peak District. Nice to see you. Hello, Chickaboy. How are you, sir? Nice to see you. Arthur Atchison. Very stormy day. I'm trying to remember where you're from. I think Ireland, but if I'm wrong about that, tell me. Hi, Margaret, Hertfordshire. Alan, sunny Basingstoke. And Paul in Kenilworth. Yeah, great to see everybody. I'm glad that the picture and sound quality is good. I listened to last week's stream, and for some reason the audio was kind of cutting in and out a little bit, but it's YouTube, and their systems don't always work well with ours. But a bit of good news, I do have a new computer on its way, which is going to allow me, as I've always wanted, to bring guests onto the stream. It should be here in probably a week. So once I get everything sorted on that, I'm thinking in the next 2 weeks we'll have some guests coming on from the peer-to-peer lending companies, and just to make it a little bit more interesting, so you don't have to listen to me blabber on for the whole, hopefully less than an hour. My goal is to get some really interesting people on here and to give their input on what's going on with their businesses and peer-to-peer lending in general. So that's the goal in the next week. We're going to shoot for, I would say, early September to have that up and running. So that's good. Hi, Mike. Nice to see you. Mike is the Lendy Action Group advocate. If you haven't joined, definitely go to Facebook. I'm sure everybody who's a Lendy investor is on there, but if you're not, do that. And hi, Stephen Hale in Nottingham. Nice to see you. So, in a dire attempt, last week we actually were under an hour. I'm going to try to keep it under an hour today as I can. So let's get right into the chit chat for this week. Lendinvest, they had a monster loan that came up this week, £12 million loan on agricultural land. It totally slips my mind where the piece of land was, but nowhere that I thought was very significant. But it was a big piece of land, 60 acres, 23.2 million in security value. So loan to value about 50.5%. My first my first reaction to a loan like that is, land loans are just so tricky because valuation on a land loan is very difficult to do. And not only that, but if for some reason the borrower runs into trouble, now you have a 60-acre piece of land that has potential, and I think planning permission to put a housing project on that. But as long as it's valued right, everything's fine. But I think one of the issues we've seen is, are the valuations accurate? Good thing, again, it's only a 50% loan to value, but I'm not wholly excited about a land loan in general, and especially one of that size. 12 million pounds doesn't really fill me with a lot of excitement. A little bit of cash invested into it, but I was surprised to see the Lendinvest, would take a loan like that, because they tend not to be so big on huge land loans like that. 12 million pounds is a big amount of money. We're talking, that's a substantial loan. So I hope and pray everything goes right for them on that loan. Definitely interesting, to say the least. But yeah, that one popped across the desk today. What's going on with Ratesetter this week? CIO Mario Lupari departs. Again, really surprised about that. He's now listed as a board executive. I had a really good relationship with Mario. I talked to him several times. I visited him at the Ratesetter offices a few times, and I didn't see that one coming at all. Now, I understand that with the Metro Bank situation, things are going to change with the higher up execs. Probably some people are going to disappear. Some people are going to be added. Maybe that's a Metro Bank decision. Maybe it was Mario's decision to leave. I don't really know. There's no information about it, but I was kind of disappointed to see that Mario departed from Ratesetter. But yeah, he's apparently moving on to greener pastures. What's going on with the Ratesetter exit market? August, we saw 6.8 million so far. I'm being exited. I'm very close to getting out of the 5-year. I think I'm position number 39. So I imagine in the next half a week, that will be one exit position. And, I was thinking about Ratesetter, and people have been sort of a little bit salty about them. But at the end of the day, the access account has not really been moving very quickly. But we're still seeing these movements towards the exit gates if we want them as investors. And I think that's a pretty positive thing. So I'm going to give Ratesetter a little pat on the back for continuing to give these exit possibilities to investors when, again, exiting is never guaranteed in peer-to-peer lending. So I'm going to cut them a bit of slack on that. And again, Ratesetter is not an exciting product to me at the moment. I don't think anybody could be excited about a 1.5% peer-to-peer lending product, but it is what it is. We're in very dire, difficult economic times. So yeah, I'm number 258 on my access spot and number 39 on the 5-year. And I think that's gone down about 30 or 40 spaces in a couple of days. So I'm pretty happy, and I'll be glad to exit out of there and move on to other investment vehicles. We're going to look at Growth Street statistics for August 2020. It seems like they're really having borrowers repay. 68 remaining lenders, 10.5 million pound loan book with 8.2 million pounds outstanding. So they've managed to drop that from 12 million pounds in July down to 8.2 million pounds in August. Yeah, that's pretty good, right? We're talking about a little bit less than 4 million pounds they managed to get back in receivables from their borrowers. It means that, the borrowers are repaying to some degree. So positive expectations for them to repay investors. I think the next payout is in October 2020. And they have bumped their expected default rate from 5 to a little bit over 6%. Probably not unexpected. I'm thinking probably that default rate is going to go a little bit higher, but fingers crossed it doesn't. What else we have? We got Lendy this week. We had a new report from the administrators, some really like cringy results on their recoveries. What jumped out here? The one that really I think was the cringiest was the gravel quarry loan up in Scotland. They had a valuation at, I believe, 1.7 million. They recovered 640,000. There was 186,000 in third-party costs, and Lendy's fee that they got paid, or that they're holding in, is being held in escrow to figure out what's going to happen with this legally. But set aside for Lendy, a little bit over £300,000, which means that out of a £640,000 gross realization on a £1.7 million loan, lenders actually received £129,000. So we're talking about what, after all the fees have been taken out, about a 10%, a little bit less than 10% recovery. It's just very cringeworthy. There was another one, Loan and Crew, again, £650,000 gross recovery on that. After all the costs were paid, lenders got a payout of £248,589. So we're talking about 40% paid to lenders. Lendy gets themselves a nice little payday if they get it of £236,000, £237,000 goes into Lendy's pocket if the court rules that way. Yeah, it's disappointing. I mean, the numbers just seem to, they don't seem to get any better. There was one that was okay. We had a £182,000 realization. Lenders paid out $148,000, so not too bad on that one. And one for $108,000 realization recovery, and lenders paid out £87,703. Again, it is what it is, but the fact that these Lendy entitlements are so high, we're talking about 1, 2, 3, 4, 5 loans for close to £500,000 that Lendy is contractually entitled to. Boo. Yeah, it sucks. Every time I read those reports, I just kind of prepare myself that it's going to be a pile of dog poo. And, especially with what's going on with all the fraudulent claims and, RSA, the administrator taking out the money, and it's not cool. But that's the risk we take as investors, right? We put our money in, we hope that people tell the truth, and sometimes they don't. That's the risk. Tell me what your opinions are on that. Put it in the chat. I would like to know what you think, because I think it's shite, but yeah. But thank God we have the Lendy Action Group that at least is doing something to stand up for investors on their side, because if it wasn't for the Action Group, the legal proceeding would never have been put forward to stop, or at least try to stop some of the things that are happening. So thank God for them. And thank goodness, Mike Powell and the group over there really stepped up and, to help out the investors' rights and stand for them. So much respect. If you can do me a favor, please, if you haven't done it, hit the thumbs up button. It helps me with the YouTube algorithm search, so I can try to get more eyes on this video, even if not today, in the future. We had an email this week from Zopa about their rates on their savings account, which were a little bit less than what they first advertised they were going to be. 1 year, 1.05%, 2 years, 1.15% a year interest, 3 years, 1.26%, 4 years, 1.26%, 5 years, 1.3% interest paid monthly. Those rates are fixed. I mean, it's are you interested in putting your money away for a year for 1.05%? This is kind of what I thought when I first heard that Zopa was going to be offering these fixed rate interest charges. That, for one thing, they can't really offer a lot of interest because interest rates are so low at the moment. So I wasn't expecting anything, but I think I was expecting a little bit more than that, just to get people in, to give them a good push from the beginning. And what's surprising is that the 3 and 4 year rates are exactly the same. So there's absolutely no benefit to locking your money up. I mean, 4 years at 1.26% savings and 3 years 1.26% savings. Yeah, I'm not touching it with a barge pole. So Zopa is a bit of a disappointment. Crowdlords, this week they have been, FCA clamped down on the mini bonds advertising. They've decided that they're going to cease regular investment offerings, and they are going, so basically if you go to the Crowdlords website, you're going to see that they are no longer operating. I've had several emails over the last year about Crowdlords, and my stance was always the same. I wasn't really too excited about them, but don't know too much about them. But yeah, so they've closed their doors for the moment, and they're looking to change operations to service only high net worth investors. Another contraction of what's going on in the peer-to-peer lending industry. And we thought at the beginning of last year this was going to happen, and it's really, COVID has sort of speeded up that process of this contraction, and some companies are exiting out of the space. Some are coming into the space, believe it or not. I've had a few emails this week of new companies that are launching that want to, they want me to review them. This is the emails I get from Financial Thing, is usually, hey, can you review our company? I always tell them, no, I won't review you, at least not a full review, until I invest my own money, because that's what I've always done. So there are new companies coming into the space, but some exiting out. Loanpad, again, slow and steady this week. They still have this exit time of 1 day liquidity. Their loan book has increased about £500,000 this week to 11.6 million. It was 11.1 million last week. Loan to value still the same, 26%. They've increased their lender base 2,033, and the default, 3 overdue loans remain the same. And their interest coverage fund, which is Loanpad's provision fund, is pretty much remained the same, just under £11,000 of interest currently being serviced. Again, still really positive when it comes to Loanpad. I think they're doing a great job, and they're practicing and doing what they preached and what they said they were going to do. So I like the Loanpad. Going to give them a thumbs up this week as always. So what else? Other news. There was a Blend Network sends these emails out every month about the housing market situation, which I find really interesting because, myself investing in quite a lot of the property-based peer-to-peer lending companies, it's good to see, what's going on in the housing market, because that does have a effect on property developers, and these property developers are borrowing money from peer-to-peer lending companies, which we, for the most part, tend to invest through. So they said there was a 1.5% rise in housing prices year on year, so versus July 2019. So this year, 1.5% rise. I think this temporary stamp duty pause is going to be, at least have a good effect on the housing market for the next 6 months to a year. You get a £500,000 holiday on any stamp duty, up to £500,000 real estate transactions. So 90%, Blend says, of property transactions over the next 9 months will be stamp duty free. So that should give the housing market a push. And that's really boding well for property-backed peer-to-peer lending companies, because if developers can build houses and sell them, and the government wants you to buy a house without stamp duty, then if the peer-to-peer companies are being run correctly, then that's going to be a good advantage for anybody that invests in peer-to-peer lending through property-backed loans. It's good news for the housing market. I don't know that that necessarily paints a really accurate picture of what's going to happen in the next 3 or 4 months, because we still haven't, again, hit that economic impact of COVID yet. I think, UK sort of entering that recessionary period that we've seen over the last couple of months. It's going to take a while for that to play out. So that may see the housing market start to decline at the end of the year. But everything still looks pretty good when it comes to the UK housing market at the moment. There was a news story on the peer-to-peer finance news about Ablrate, David Bradley Wallet, and he blasted the CBILS lending through the banks. And at first I was reading it, I read the title, and I thought, oh, what's the problem? And CBILS is a good thing, right? I mean, the government offers 300+ billion pounds for companies and businesses to borrow against. And then when I read the news story, I was like, wow, David is actually really spot on correct about what he's saying. And 13 billion pounds has been lent out, CBILS loans. The problem, as David points out, is that the banks really don't want to lend to the bigger businesses, because only 80% of the loans are guaranteed. So the other 20% is not guaranteed. And there's a good chance that some of those loans are going to go belly up because it's terrible economic conditions and these businesses are struggling to survive. So what does a bank do? A bank will say, I don't want to lend the money to these CBILS loans because 20% of that loan is guaranteed by the bank. And if it fails, then the bank has to eat the 20%. Now, what there is this concession for smaller businesses to get 100% loan guarantee from the bank. And those are much smaller loans. So what banks are doing is they're lending out to these small businesses because they can get 100% of those loans guaranteed by the government, so absolutely zero risk to the bank. So what David was really complaining about is exactly that the banks are really just looking out for themselves at the end of the day. They don't want to take a risk on bigger businesses for that 20% of the loan that they have to take on goes upside down. Then that affects their balance sheet, which in turn, if they're a high street bank, affects their share price. Now the share prices start to drop, and the share investors and the shareholders are not happy. So the banks really are doing the UK businesses a big injustice. But not only that, probably more that the government should have just guaranteed the loans themselves, 100% guarantee, maybe to all the bigger businesses too. I think that if there's a 330 billion pound pot of money and only 13 billion gets lent out, there are some other issues, I think, that have stopped that money being lent out, and probably something to do with administration. I mean, a lot of loans, they don't run through very quickly. It takes a lot of paperwork. I have a friend that's doing loans through a bank, and she told me that they've had something like 13,000 applications. They just can't keep up with the paperwork, and they can't process them quickly enough. So I think you're going to see some of that. But the same token, only 13 out of 330 billion pounds, we're talking about 4% of the money that's been promised by the government lent out. That's a huge problem. And is that number ever going to hit 330 billion lent out? Probably not. But I think the government's kind of really shot themselves in the foot by not guaranteeing the loans. At the end of the day, the taxpayer has to front that bill. So it's a big problem. But if you're going to guarantee 80%, just guarantee the 100%. What's the point? You're guaranteeing 66 billion. Sorry, you're not guaranteeing 66 billion out of the 330. There's no point. If you're going to lend out 330, guarantee the whole thing. That's my rant for the day. Another interesting news story is this is on the American side, but there's a company that did a study on, I think, 1,100 Americans about their retirements. They said 72% plan to work into retirement now. 1 in 5 Americans in their 60s have lost their jobs or have been furloughed due to COVID-19. 20% of Americans are now planning to tap into their retirements because of the layoffs. This was pretty scary. 63% of African Americans could not come up with $500 of cash today without selling something or taking out a loan, compared to 35% of white Americans. So even though 35% of white Americans don't have access to $500 in cash, that's really scary. It says a lot about the state of the economy and how poorly, people have planned for a disaster. So 1 in 5 Americans could not last more than 2 weeks off their savings. And 45% of Black Americans and 43% of Hispanic Americans could survive less than a month on savings versus 33% of white Americans. And half of the Americans saying that they need a stimulus check to bolster their finances. What do we really say about that? I mean, obviously this huge disparity between economic conditions for the different racial sectors in America of struggling, the minorities who cannot survive less than a month on their savings. I think you're going to see a lot of that in the UK. I mean, the UK tends to be more of a saving culture than America. America's more of a get your credit card out, go swipe that flat screen TV, go get that new car loan. I think the average car payment in America is close to $480 a month. But COVID has definitely not made anything better. And it's really down to a severe lack of financial education at the end of the day. And I remember when I went to school, I was taught absolutely nothing about personal finance. I mean, you sit in an economic class when you're a kid and they're drawing graphs, but they never teach you about personal finance, about, look, if you start saving 20 pounds a week now while you're young, you can be a millionaire by the time you're 50 years old. Nobody explains that in school. I think it's starting to change a little bit, but there was a severe lack of financial education. And I think this is just the result of, especially my generation, not having access to the internet when we did, during the important years. I'm 47 years old, but when I was 20, which is the time that I think we start to look at things like investing in our 20s, there just wasn't that information out there like there is now. So what I'm really hopeful for is that, future generations, because they've had access to the internet when they're young, they have access to really good education, that they're going to understand finance and investing a lot more. And I don't always see that. I do talk to younger people in their 20s and 30s, and I'm surprised when people tell me they don't understand about investing, or they don't understand about ISAs, or in the US IRAs, 401ks. And what's more surprising to me, that people don't really understand what's in their investing portfolios. They go to financial advisors who put them into things that they don't really understand. And that's what puts people off from investing, I think, is the lack of understanding about what to invest in and what's the right things to invest in. So that's something that, I'm really passionate about, is financial education. One of the reasons why I started doing the website, financialthing.com, was to try to educate and give free education to people to be able to set themselves up. Because I think back to when I was in my 20s, and I wish to God that I just had this information that I know now. Back then, I could have started to invest at a really young age and been in a much better position than I am right now, because I'm playing a serious game of catch up, having really started investing seriously in my early 40s. About 5 or 6 years ago, I really started to take investing seriously and becoming knowledgeable in the different ways to invest. But it seems like America has a real problem with retirement. And also, don't get me started with the tax situation, because the things that I think Americans rely on, like Social Security, and probably in the same way in the UK, the national debt is just a massive, massive problem. And I fully expect that we as taxpayers are going to be stuck with a bill at some point. I think taxes are going to get raised in the UK. I think they're going to get raised in the US. People say that, oh, the tax rate is high right now. It's actually not, and sometimes in the US, the tax rates are up to 94% in the 1940s for the highest tax bracket. It's really funny. I read something about Ronald Reagan back in the 1940s. For anybody that doesn't know, Ronald Reagan, past US president, was a movie star. And he would only work 2 movies a year because he was paid $100,000 to work a movie. And his tax rate, if he earned more than $200,000, was 94%. So it didn't make any sense for him to work any more than 2 movies a year and earn any more than $200,000. So it's very possible that our tax rates are going to get raised to pay for all of this huge amount of debt that our governments have managed to accumulate. So, yes, American retirement is in a dire situation for at least some parts of the people. And I think the same goes for the UK. I found that interesting. Very interesting. So, drop your comments, and I would like to know what you feel about that. That's my couple of rants today about CBILS lending, and also, by the way, that $13 billion lent out, the 80% of it is going to be paid by the taxpayer, which is us. So, and then if it does somehow manage to hit the 330 billion pound lending, we're going to be paying through the nose through our taxes in some way. Yeah. So use your ISAs if you're not using them. Use your ISAs because you get that £20,000 tax-free investing, and that's pretty much the only thing the government's going to do for you, is to give you that. Anyways, let's have a look at the comments before I rant anymore. By the way, yeah, I'm getting a little bit disappointed. I feel like there was a Times article this week, I think it was in the Times, about peer-to-peer lending and how it was dire times and everybody's running for the exits. And I'm starting to think, God, this sector that we're in is really taking a beating right now. And I think there's some really bright spots. I say this every week. Peer-to-peer lending companies, there are some bright spots out there, and I think there's some good places to invest. But if you pay attention to the media would think that we are in the worst investment sector ever. And it can get a little depressing reading about the bad news every week in and week out. We're looking at what's going on in China, and their peer-to-peer lending situation has been a complete pile of poop too. So every time I see a little bit of good news, I get excited about that. Assetz Capital, by the way, they announced they have struck a deal with a company called Nordic Finance to provide and fund CBILS loans. And, it's funny when I was thinking about when these peer-to-peer lending companies decided to sign up to be a CBILS lender, they would have to find some way to fund those loans because peer-to-peer lenders cannot fund CBILS loans. So Assetz is announcing they found a finance provider. Didn't really give too much details about how much money is going to be provided to them by Nordic, but it's good to see that they're making forward progress in their CBILS lending. Anyway, I will read the comments and see what you have to say. We're doing pretty well today, 33 minutes. Please hit that thumbs up if you're watching and you're enjoying the stream. Put your comments in. Subscribe to the YouTube channel if you can. Oh, by the way, before I go to the comments, if you haven't seen, I just posted a video on Financial Thing. It's on YouTube too, about Bitcoin investing. I do a full walkthrough tutorial on how to buy Bitcoin through Coinbase Pro. As I told you, if you're interested in crypto investing, which I am, I'm not a big investor. I put a little bit in there every now and again. If you look at the Bitcoin prices, they're really starting to take off. What I think is going to happen, I think Bitcoin is going to probably try to hit the $14,000 US mark. And if it does, break through that, I think you're going to be looking at it going up to 20,000 from there. So not a bad place to stick a little bit of cash away as a speculative punt. But the tutorial will show you how to save fees. The problem with Coinbase is they have sometimes a fee rate of up to about 4% of a purchase, whereas Coinbase Pro is 0.5%. The two companies are exactly the same. Coinbase Pro is a little bit more difficult to use because it's a trading platform. Looks like a stock trading platform. But I do a full tutorial walkthrough on how to actually buy. I do a crypto Bitcoin purchase, and I show you how to transfer from Coinbase straight over to Coinbase Pro. It's in real time. It's very fast. And then show you how to buy the Bitcoin and transfer the Bitcoin back out of Coinbase Pro back into your Coinbase account. And also, I've gone ahead and recorded, like I promised, the Vanguard video. If you're interested in buying index trackers, you don't know quite how to do it, I've done a full walkthrough tutorial that I just posted. It's up on YouTube. It's unlisted. I was going to post it up on the Financial Thing website in a couple of days, so I thought I'd give it to you a little bit early. So yeah, that basically, again, a complete walkthrough of buying an index tracker. I buy the US equity index tracker through Vanguard UK. Just show you how to do it, show you how the website works, give you some information on the tracker. So check those videos out. Let me know what you think. I'm trying to do more of these tutorial walkthroughs about the things that I chat about that you may not know how to do. Yes, that's news. Okay, so hi, Chimp on Naughty. That's an interesting name. I get a kick out of some of your usernames. In Cambridge, we've got Chimp O Naughty. Annabelle in my home county of Dorset. She says it's very windy and she's quarantining. Annabelle, do you have COVID? Is that why you're quarantining? Hope not. Hi, Beverly in Windsor. Oh, good. Annabelle's fighting fit. Scott Peacock in beautiful Norway. Is that where you're based, or are you just having a holiday? Hopefully. Brian in Woburn says hi. We got Margaret Sims here. Margaret says, does the Metro Bank buyout of Ratesetter worries you? I have quite a lot of money with Ratesetter. Historically, I put too much in. I hear they've been bought out as a low value. Is that a bad sign? Well, knowing what we do about Ratesetter's financials, we really don't know all that much. But I would say having a bank behind you is a very positive thing. Now, that's not to say that something can't happen to Ratesetter, because number one, Metro Bank could go under and pull down Ratesetter with them. But I would say fundamentally having a bank behind you to provide you with financing to write new loans is a really good thing. So I think they're more secure now at this point. The valuation was definitely low, but I think, it's like selling a piece of property at the worst time. Ratesetter sold at probably the worst time it could have, and I think the valuation was what the valuation was. When you buy a business, you're basically looking at, incoming and outgoing, and Ratesetter has had times of profitability, but it's also had times when it's been in the red, and Metro is going to look at that, and Ratesetter probably didn't have an awful lot of options to. I don't think you would have seen, lots of people coming forward trying to buy a Ratesetter during COVID, so Metro was probably its only opportunity, and I don't necessarily think it's a bad sign. I don't think it's a good sign. I'm neutral on the valuation. Obviously, the business is valued at what it's valued, but what I look at is, can I exit from Ratesetter if I need to? And so far, I'm seeing, at least, on the 5-year product, that it is pretty liquid. It's not where we want it to be. It's taken some time, but versus some of the other peer-to-peer companies that are offering zero liquidity and no exit, I'd say your Ratesetter is okay. I don't think you need to have a lot of money into any one peer-to-peer company at this point. I certainly wouldn't want to have too much of my own liquid assets in any peer-to-peer company. I would still try to spread it out and be pretty even, just in case something does happen to one of them. But at the rates that they're offering right now, 1.5% on Assetz, why would anybody want to be in? I personally, I'd rather take like 0.5% in a savings account than 1.5% in Ratesetter. It's just not worth it. I mean, you're talking about a 1% difference for certainly a lot more than 3 times the risk. And no FSCS coverage, so I think you find better places to put your money than Ratesetter. I mean, Loanpad is offering better rates. Assetz Capital's QAA, which is far from quick access, but yeah, it's offering better rates at the moment. And then some of the property-backed peer-to-peer lending companies, you can take more risk and get more reward. So, but no, not too worried about them at the moment. What else we got? Hi, Martin in Leeds. I'm very happy with Loanpad. Must take care not to overdo it again, just in case something nasty happens like Brexit. I think that's a great point. Again, just because, Loanpad's high up on my list right now, probably my favorite peer-to-peer lending company, along with the others on my top 5, still doesn't mean I'm going to put my life savings into Loanpad or any one of those companies, because, we know what can happen. There is risk. Annabelle says, I like the technical terms tonight. Shite and dog poo. My mum is listening, 85 years old, and chuckled. Apologies to your mother. I don't know if shite is appropriate for a YouTube stream or not. I think adding the E sort of softens down the shit to the shite, but yeah, apologies to your mother. Maybe you could block her ears. I don't know. Tell her to stick her fingers in the ears in case I say something inappropriate. Scott says, Lendy situation is disgusting. How is it legal for the Lendy company to walk away and get priority recovery? Unfortunately, because of their terms and conditions that they snuck in there, that gave them this waterfall. And we'll see whether it's legal for Lendy to do that. There is going to be a contestment of what's going on with the administration process, and ultimately, I guess the courts will decide. But I think if the FCA were to get involved, and any judge that had half a brain would look at that and say, can they overturn the terms and conditions because of misleading people or fraud? I think, yes, there is a chance that that could happen. And that would be a great result. I mean, if for some reason, those allocations to Lendy were nulled out and paid out to investors, then somewhat justice would be served. That's what I'm hoping for. Again, I don't know if that's going to happen, but think positively. Glass. It is a glass today. I hope I don't get the hiccups. Martin says, I was in Iceland 10 years ago when Corp thing edge collapsed. That was fun. Does Iceland have any good financial news or rates these days? When I hear the word Iceland, the only thing I'm going to go do is go to the supermarket Iceland. I certainly don't think I'd invest any money in Iceland, or probably not any European or non-European banks. I think the FSCS protection means something, right? It's just where I'd rather put my cash. I haven't looked at Iceland's rates. Don't think I'd want to take the risk. Thank you, Chica Boy, for the thumbs up advert. You're always a good cheerleader for me, Chica Boy. I appreciate that. Brian says, Gordon Brown used terrorism legislation to stop CAP thing, transferring our UK funds back to Iceland. That averted huge losses for many UK investors. Thank you, Mr. Gordon Brown, for doing something to protect savings rates. Thank you, Paul Bagworth, for hitting the thumbs up. Thank you. Hi, Teresa Mota. Special hello to you from the DR. Does that mean you're at the doctor's office? But I think that means you're from the Dominican Republic. Let's see. Where is Mr. Aki Chap tonight? He's not here. The comedic duo is falling short. We only have one comedian. Oh, he's here. There we go. Aki Chap is here. He's in the background eating his cake and ice cream. Nice to see you from Accrington. Brian says, has anyone used the Assetz secondary market yet? Average discounts around 6%, and investors are buying. Will be good for liquidity in the access markets. Brian, you make an excellent point. For everybody that's bitching and complaining about selling at discounts, what it's doing is it's creating liquidity. I'd say pause, be patient. I don't think that the discount's going to be 6% forever. It might take a couple of months for it to settle down, but again, it's showing that there is a appetite for people actually wanting to buy discounted loans for Assetz Capital, which shows that investors do have confidence inside of Assetz Capital. Personally, I am not selling out of assets. I'm just remaining as is. I've always had confidence that the company will be sail on in a forward manner. So I think sometimes, remaining on that strategy is a good thing, because if you're flipping in and out of things, it's like stocks, right? If you buy when things are starting to plummet, it can be a bad decision. I don't know, I don't have any outlook for the future, but I have a good feeling that, the companies on my top 5 list are going to be okay, and other companies too. So I'm happy for the asset secondary market. I would like to see the 99.9% discount changed, because you can sell your loans for almost free, give them away. I think that's stupid, because somebody's going to make a mistake and then put the wrong amount with their discounting. That seems to be a bit of a coding mistake, but we'll see. Thank you for saying I look younger than 47. Do you mean I look maybe 46? Scott says parents should teach their kids financial control and investing for the future. I think you're exactly right. I think one of the problems is most parents don't understand. It's hard to teach something if you don't really understand it yourself. I know when I was a kid, my dad didn't understand anything about investing, so he didn't teach me. He just said, look, try to save as much as you can. But, saving doesn't really get you ahead in the long run because of inflation. You have a huge risk of inflation eating away your savings, especially when interest rates are low. So you really do have to find ways to invest. And unfortunately, my dad just didn't really know. He had a financial advisor, so his sort of advice was go find a financial advisor and let them do it. And I was really petrified of financial advisors. I didn't understand investing, and I think if the parents don't understand, how do you teach your kids? And that's my goal, is to teach parents too. I have a big passion for parents investing for their kids when they're very young too. If you were to shove away 20, 30 pounds a week for your child when it's born, that child can really have a great start over 20, 30 years time to that amount of money that's been invested for them. So there you go. Tony says, with Growth Street, as the loan book decreases, the apparent increase in the default rate is based on a smaller amount. Lawrence, please clarify, is the default rate based only on the loans not yet repaid? Yes, so what's happening, Tony, is the loan book starts to decrease. The default rate is starting to increase a little bit, and that's pretty normal. What you're going to get at the end is probably the borrowers that are struggling to repay, and I think you'll see the default rate continue to rise just a little bit. To what degree, I don't know. I'm thinking in my head somewhere around 8, 9, 10%, but again, that's just a complete guess. But yes, that is based on the default rate on loans that have... What they do is they base it on their entire loan book, whatever is outstanding. So they have a historical default rate for their entire loan book, and then you can look for previous years too. There's a lot of talk about ice cream. You're making me very hungry. Do you ever get the you go through periods of time where you just are not in cooking moods, and then you open your refrigerator and you just don't have a lot of food, but you don't want to go to the supermarket. That's where I am right now. Yeah. Yeah. So the ice cream is making me hungry. Annabelle says, if it hadn't been for a young financial advisor advising me to put 25 pounds a month aside for a pension when I first started work, I'd have had nothing to put into peer-to-peer today. And that's a great point, Annabelle. And, you know, I do bash financial advisors a lot, and I'm pretty hard on them. And I think they have a place for people who have no knowledge of investing. And I think financial advisors in that respect are great, because it's better to have somebody investing through a financial advisor than not investing at all. And in Annabelle's case, that's what happened for her. Paul says, with tax rises in the pipeline, keep your ISAs topped up before they stop. Yes, I agree. Martin said, I put my ISAs with Funding Circle. What a disaster that was. Yeah, that's something we talked about last week. You know, when you're doing ISA within peer-to-peer lending, you want to make sure, again, that you're not putting your entire ISAs into, you know, 1-2 companies, because something happens, your ISAs are in jeopardy. I prefer to take a little piece of an ISA. If I'm going to use an ISA, put it in one company, use previous year's ISAs to sort of split it up and never have too much invested. AccuChap, thank you very much for joining my Loanpad referral. If you want to join Loanpad, there is a cashback offer right now. You can get up to £100 free money. There's a link if you want to sign up and support Financial Thing through my referral link. Appreciate that. Cheeky Boy says, you've been with Loanpad for 3 years. I trust them. Have you really? Yeah, I think 2 is more accurate. But I think that the Loanpad has been good. Chimpo Naughty. Don't apologize for your username. I like it. It's good. Darren. Nice to see you, Darren. Thanks for joining the stream. If you haven't joined before, this is where we talk about peer-to-peer lending and investing. Let's see. Just reading through your interesting comments. It's funny how we talk one week we talk about tea and the next week it's ice cream. Favorite ice cream flavor? Definitely mint chocolate chip. I love that. But it has to be the good stuff. Ben & Jerry's is just good. Yeah, so what else? Oh, another thing that I've been doing, I've been sort of experimenting this week with, and this is something for people who like buying individual shares. I know there's some of you out there that do that. Is I've been looking into doing some covered calls. I think I talked about this before. Covered calls on which are options on shares. So if you own shares, you got to have at least certain lots of a certain amount of shares. So say you own 1,000 shares in BP, you can write a thing called a covered call on 1,000 shares. And what it does is basically you're setting a price. Let's say BP shares are £1, and you say, I'm going to sell my BP shares at £1.10. That becomes the strike price, and a investor or a trader will pay you for that option. They'll pay you a premium. Now, every share has a different premium. The further out you look, the premiums change. The shorter the time frame, the premiums are higher. The longer out, premiums can be smaller. And I find it's a really interesting thing to do, because you could essentially, if you own shares in your portfolio, if you say you set a £1.10 strike price on your BP shares that you own, and somebody pays you a premium on that, and the price doesn't hit £1.10 by the date that you choose, you get to keep the premium. What's the downside? The downside is if the share price were to go to, say, anything above £1.10, you've lost out on the upswing. So if it shoots up to £1.50, obviously you've missed out on that growth. But the upside is you don't have to take so much risk. You can sell the share out for £1.10, receive your premium, and then rebuy the share again and do the same thing the next month. It's essentially like you can guarantee yourself almost 2 to 3% a month on the share. Now, the only downside of a strategy like that is if the stock market corrects. Let's say you were holding your BP shares that you paid £1 for, and the price drops to 70p. Well, you obviously didn't hit your £1.10 strike price, so your shares, they don't get sold. You still own them. You get to keep the premium from the option covered call, but you now have a stock that is worth 70p instead of £1. What does that mean to you? It means that if you are buying shares in companies that you don't mind holding very long term and the share price drops, so you just wait for it to recover. Obviously, if the price goes down to 70p, it doesn't make sense for you to write options on that anymore until the price recovers. Because if you wrote an option at 80p, when you paid £1 for it, you're going to lose 20p on a share, less your premium amount. So you're not in good shape there. But if you have stocks in your portfolio that you've held for a while and you don't mind holding if they decline, and also stocks that don't fluctuate too much, there's certain stocks that really don't tend to move as much as other ones because for whatever reasons, where they have debt problems or, I'll give you an example, like in the US, AT&T, which pays a big dividend of 6%, which is a big phone carrier in the US. They don't tend to move very much, so you can write options, and chances are your option's not going to get called because it's probably not going to hit the strike price. And if you set your strike price, let's say AT&T is £20 and you set your strike price at 23 or 24 pounds, chances are AT&T stock's not going to go up 10%. Also, if you do it with dividend stocks, then if you are holding onto the stock and the price happens to correct downwards, you're still getting paid the dividend. So again, there's a little bit of downside protection there. It's not a strategy that I would do on my entire portfolio, but it's something that I think is a really interesting strategy. It sounds more complicated than it is. Again, it's about buying a lot of stocks, say of 1,000 in the UK. I think is the minimum in the US. It's 100. So you buy whatever stocks you were wanting to own anyways, and then you set a strike price that's higher than what the stock currently is. So you make money on the uptick in the stock and you get paid a premium. And if it goes down, you don't mind holding the stock anyways because it has a dividend and you're planning to hold on to it long term. Again, it's not something you want to do with volatile stocks unless you're a gambler, which I'm not. But that is something I experimented with this week. Should have recorded a video about it, but I totally forgot. But the options are going to expire on September 11th, and I'll keep on redoing it. So I'll record a video if you're interested in learning more about that kind of strategy. I think it's something you could use to diversify. So anyway, tons of stuff about ice cream today. I love reading the chat. So Mike says apparently Loanpad has a new lending partner. Oh, but yeah, I did not hear anything about that. So, Mike, do you know who the new lending partner is? Mike always has his ear to the ground. He sometimes gets news a lot quicker than I do, which I love. The fact that he shares that news with us, because I'm not CNN. I don't always get the news before everybody else. So I just commentate on it. Yeah, cookie dough ice cream is very, very good too. So anyway, we're a hair under an hour. I'm going to try to wrap it up. Thank you for everybody joining. Again, please come and join the Financial Thing Facebook group. Have a chit chat with us. Check out the new videos that I posted on financialthing.com with the Coinbase Bitcoin purchasing and the Vanguard Index Tracker purchasing. And if you have any comments, leave them. Please hit the like. Please subscribe to the channel. And I will be here next week, bright and early, 7:30 p.m. Thank you, everybody. Have a great night. And I will speak to you soon. Take care.